Nvidia stock is up over 1000% in the past 5 years. But right now, it's actually 14% off its highs. While most people see a bubble bursting, the data shows Nvidia is trading at its cheapest valuation in years, a forward PE of just 20. Today, I'm going to show you why the market has this completely backwards. And I'll reveal the exact price I'm willing to pay for Nvidia stock towards the end. Most people know Nvidia from their consumer graphics cards, but the explosion in the company's revenue comes directly from a new business that took decades to build. Starting as a gaming company in the early 2000s, Nvidia made graphics cards. Their graphics cards, more commonly known as chips, completed thousands of tiny calculations at the same time, which was perfect for video game graphics. But at the time, nobody believed the technology was useful for anything else. However, in around 2006, Nvidia noticed something unusual. The same parallel math used for graphics could also be used for scientific computing and AI math. The problem was there was no way for developers to talk to the GPU. It was like having a Ferrari with no steering wheel. So Nvidia spent hundreds of millions of dollars building that steering wheel. And the steering wheel became CUDA, a software which allowed developers to use Nvidia's GPUs for anything, not just graphics. CUDA changed everything. Then in 2012, deep learning took off. AI needed massive amounts of parallel math. GPUs were perfect for this. And Nvidia already had the hardware with their GPUs, the software with CUDA, and an active developer ecosystem. Everybody else was years behind, which made Nvidia the default engine of AI. But Nvidia didn't stop there. They built specialized AI hardware, AI libraries, networking, AI computers, AI data centers, enterprise AI software, and cloud services. They went from selling parts to selling entire AI factories. From 2020 onward, every company wanted access to chatbots, recommendation engines, LLMs, generative AI, and autonomous systems. This requires huge amounts of compute, leading Nvidia to become the supplier of the modern AI economy. And if we take a look at Nvidia's fundamentals, we'll see how the story aligns with the numbers. When Nvidia launched CUDA in 2006, the company generated revenue of $2.38 billion. By 2016, the company's revenue had already doubled to over $5 billion. And in their 2026 fiscal year, Nvidia generated an insane $215 billion in revenue. You might look at this chart and think, how can this growth possibly continue? And we'll get to that shortly. Nvidia's revenue growth rate over the past 10 years was a whopping 45%. To put that into perspective, most companies would be happy with annual growth of 10%, while Nvidia's revenue growth rate over the past 5 years actually accelerated to 66% and grew at an annual rate of 88% over the past 2 years, while moderating slightly to 65% in the past year. You might be thinking, we've seen the revenue, but how profitable is this company? Well, if we take a look at Nvidia's margins, you can see that in 2006, when CUDA launched, Nvidia's gross margin was 38%. Then, by 2016, Nvidia's gross margin had climbed to 56%, and in 2026, their gross margin came in at 71%. Gross margin measures the profitability of the company's products, so it doesn't include operating expenses. The trend is clear. Nvidia's products and services are becoming more profitable over time. However, because Nvidia spends so much money on research and development, they spent $18.5 billion in 2026, we have to focus on the company's operating margin to get a true measure of Nvidia's profitability. Nvidia's operating margin paints a slightly different picture, at 16% in 2006, rising to 60% by 2026. Despite a more bumpy ride, the operating margin shows the same positive trend as the gross margin. But the massive revenue growth combined with expanding profit margins is why the stock went so parabolic over the past 5 years. Profit margins tend to act as a multiplier, because it means profits grow even faster than revenue, and the market tends to focus on profits rather than revenue when valuing a stock. Next, we're going to look at the 3 tailwinds and 3 threats for Nvidia's business. Then we'll look at the valuation, and I'll show you the exact price I'm willing to pay for the stock. A tailwind is an economic trend that helps a business grow. And the first major tailwind for Nvidia is the AI capex cycle. Companies like Alphabet, Amazon, Microsoft, Meta, and Oracle are spending hundreds of billions of dollars to build out their compute capacity. This means huge demand for Nvidia's GPUs. Like many investment cycles in the past, a slowdown is inevitable, but for now, Nvidia's printing cash. The second major tailwind for Nvidia is AI enterprise adoption. It seems that as AI becomes better and more available, businesses around the world can't get enough of it. The use cases are endless, and the adoption of AI agents, basically digital employees, is exploding. Much of that demand by businesses will flow through Nvidia at one point or another. The third major tailwind for Nvidia is sovereign AI demand. Nation states are pouring billions of dollars into their own AI infrastructure to reduce their reliance on the American big tech companies supplying it. This might not be as big a tailwind as spending from the hyperscalers themselves, but it all adds up, and I'm sure Nvidia isn't going to say no. Then we have three main threats to Nvidia's business. The first being competition. For years, Nvidia had a free run at the market, thanks in part to the ecosystem we discussed earlier. However, due to the huge demand for AI compute, other companies are trying to carve out a place for themselves. The closest competitor right now seems to be AMD, led by Lisa Su, who happens to be the cousin of Nvidia's CEO Jensen Huang. But while the competitive threat is real, the likelihood of AMD taking major market share from Nvidia is low because of CUDA's head start. There are other threats from Alphabet and Amazon, who developed their own custom chips for their cloud computing businesses. But the whole reason Nvidia became so dominant in the first place was because of their GPU's versatility. Alphabet and Amazon's chips are designed to be more specialized, therefore less likely to be a hit in the wider market. The second threat to Nvidia is customer concentration. The top four hyperscalers make up between 40 and 60% of Nvidia's revenue. On the surface, this seems bad. However, the truth is that these hyperscalers are all competing with each other. They need the capacity that Nvidia is offering, and if one of them decided to reduce spending, the others would take that capacity and use it to gain cloud market share. The third threat to Nvidia is growth slowing and margins compressing. The market believes that this is inevitable, and if investors are right, it would cause a massive sell-off in Nvidia stock. However, I think it's reasonable to assume that AI demand will only grow from here, especially with AI agents, autonomous vehicles, and robotics viewed as the future of the global economy. Right, now for your favorite part of the show. We're going to look at Nvidia's valuation, and then I'll reveal the exact price I'm willing to pay for the stock. Nvidia currently trades at a 30 trailing PE. Trailing meaning based on Nvidia's earnings in the past 12 months. However, the company's forward PE ratio, which is based on estimates of Nvidia's earnings in the next 12 months, is at 20. For a company expected to grow earnings by 87%, this is astonishingly low. So to estimate the return that Nvidia stock could provide over the next 5 years, we're going to use the DCF calculator. We have to provide assumptions for Nvidia's earnings per share growth over the next 5 years, and decide on an appropriate PE multiple for the stock to trade at. As we can see from this chart of Nvidia's earnings per share, the growth has been outstanding. EPS grew at an annual rate of 95% over the past 5 years. Even if Nvidia grew at half that rate over the next 5 years, the returns from today's price would be enormous. Market analysts are projecting EPS growth for Nvidia at around 35% over the next 5 years, and I don't think they'll be far off. So for our valuation model, I'm going to assume annual EPS growth over the next 5 years of 30%. Then we need to apply a reasonable PE multiple for Nvidia to trade at. The current earnings expectations combined with expanding profit margins make me confident that Nvidia can trade at a 35 PE multiple. Based on these assumptions, Nvidia stock could increase from $200 to over $630 per share in the next 5 years. That's a 3x increase and a 26% annual return from today's price. Before I even consider buying a stock, I want a reasonable chance of annual returns above 15%, so I'd be willing to buy Nvidia stock below $315 per share, suggesting the stock could be a great buy today. At the moment, I'm happy with the portfolio, so I won't be making an investment in Nvidia right now. But regardless, I believe Nvidia stock currently presents a massive opportunity for investors.